All right, Methodical Man here. Welcome to the video. I'm going to go over today kind of the strategy that I've been using. I had a couple of requests for me to make a video on it, so that's what we're doing this morning. Hope you guys are enjoying your weekend. It is a Saturday morning here. But basically, I've been trading the inversion gap strategy for anybody who's new to this video or who hasn't been watching my channel. And no fluff. We're just going to get right into it. So with the inversion strategies, we have three different examples. Okay. Each setup is similar to the other with very small differences. And the win rate does vary based on the setup. Now, I've never tested each individual setup as far as like what is the win rate for each individual setup. My win rate runs north of 80%, and I do take all three setups. So you're just going to have to kind of do your own back test if you're wanting to just only trade one setup versus the other, so on and so forth. Otherwise, you can trade all of them if you want to. So let's go over the setup. So we'll go over this one in the middle first because this is the lowest probability setup. So all this is, we just have a shift in structure. You don't necessarily have to have a shift in structure, but you just have a swing high. We don't sweep liquidity on a pullback, so we don't breach the previous swing low. And we leave a fair value gap in this leg. So that would be, this green box will be indicative of a fair value gap in this leg. And then price does not sweep liquidity, and it simply closes back above the fair value gap that we just created. All right. You would enter on the close of the candle, or you can enter on the pullback. The difference is you'll get a little better RR if you enter on the pullback, but you don't always get a pullback. So just remember that. I personally enter on the close of the candle, and then the next internal liquidity to the left. So your next swing high to the left, which in these scenarios, we're just going to use the one that we created, would be your scale point if it's 10 points, or your break-even stop, both. So once we hit the internal liquidity, you can scale some of your position to guarantee some profit, and then you move your stop to break even, and you see if price continues higher to a higher target, equal highs, whatever the draw on liquidity might be in your mind, okay? So I'm going to rank these just kind of ABC type deal there. So it doesn't mean that that these are bad setups. It just means that, I don't know, I never used this before. There we go. So if we were just rating them ABC, this is your C setup. So the lowest probability, which still has a very good win rate. Like I said, I don't know exactly what it would be, but this one would be kind of your C setup there. So your B setup would be this one here. So let's go ahead and mark that out. This would be the B setup. And the difference in the two, there's only one difference in the two setups here. This one simply sweeps liquidity. So this one takes out some form of liquidity to the left. So in this case, it would have just taken out this swing low. So sweeps the swing low and then creates a fair value gap. We close back above the fair value gap here on your B setup. Again, I would take the close of the candle, stop to break even here at the swing, and I usually scale there. Now, one of the things you'll see me do when I use this strategy, I do scale at the internal liquidity. It doesn't matter if it's 5 points, 10 points, 4 points. I'm going to scale some of my position at the internal liquidity. You don't have to do that. The reason I do that is because this strategy does have a very high win rate, but I would say that probably 25-30% of the strategy is going to be break even because you move your stop fairly quickly with this strategy, and that's what I like. So the difference between B and C is simply B sweeps liquidity on the way down or up. This would be reversed for a short. So it sweeps liquidity, leaves a fair value gap. We close back above the fair value gap. You enter there, or you can wait for the retrace, and then you stop to break even at the swing, so on and so forth. Now, one of the questions would be, where does your stop go? Your stop is a candle close back below the fair value gap that was inversed. So let's just look at that for just 1 minute here. So let's just say, I don't even know which one I chose here. It doesn't matter. We can come here. So if we get a candle and it comes and it closes here, then you would close your position. If it closes below without hitting the internal liquidity, you close your position. Now, let's say this candle pulls back, does not close here. So there's a wick. It closes back up inside the box, the fair value gap, and then comes back up and sweeps the internal, it sweeps the swing that it just created. Then this would be your new break-even point, if that makes sense. So a stop would be a close below. So a close back below, you just close the trade. Now your highest probability setup, the one that's going to have the highest win rate and that's going to kind of work the most, is going to be this one over here. And the major difference between this one and this one is you are delivering from a fair value gap. So what that means is we are going to still sweep liquidity. So we're sweeping this swing, right? So we sweep liquidity. Doesn't matter. It could be this swing. It could be one further to the left. It doesn't matter. We just sweep some sort of liquidity. We tap into a fair value gap down below, so a bullish fair value gap below. Then we disrespect a bearish fair value gap, and we close above it. Once we close above it, you take your entry. It's the same process. Same process. So close below, above, you take your entry, scale at the swing. If you want to, you at least break even stop at the swing. So that's kind of the idea of these setups. This is going to be your strongest setup, the highest win probability. You could only look for these setups if you wanted to during the day. So, and again, on this one, same thing. You would close back below the gap would be your stop loss. That would be your stop out. Now, you can take these on any time frame, 1 minute, 2 minute, 3 minute, 5 minute. I prefer the 1 minute, 30 second. I prefer the 1 minute because I like the fact that the candle closes sooner. So if it's going to be a losing trade, it's probably going to close much closer to the box, to the bottom of your fair value gap on the 1 minute time frame than it would on the 2 or the 3. The 2 or the 3 minute, sometimes you might have to eat a candle that's down here and then it closes back up here. On the 1 minute, that's a little less likely. So I marked out a couple of examples just from yesterday. I could only find 2 really. I didn't really look that hard, to be honest, but this would be a C setup. You can see these do work, right? So why is this a C setup in the example that we gave there? Did it sweep any liquidity to the left? Nope. So price pushed up, no liquidity swept, pulled back down, left a fair value gap here. And then we pushed right back up, closed above it. So this would be your entry if you're taking the candle close. Let me, there it is. So your entry would be here. And then your stop would go to break even at the swing here. So this is just an example of a C setup. No sweep of liquidity. And then you would take the close above. There you go. This is an example of an A setup. So we have a fair value gap to the left that you can see price tapped into. We left, I think this is maybe on the 1 minute. It might be on the 3 minute. Let's see. Yep, 3 minute. So we tapped into this fair value gap here. We swept this liquidity here. So we swept this swing, tapped into the fair value gap, pushed back up, closed above. So that close above would be your entry. So right there, you'd enter. And then once price reaches here, you move your stop to break even. And I would scale there some, and then you just target, wherever you want your target to be. You look to the left. So excuse me, guys, you look to the left for your target. So maybe there. So that's kind of the way that I trade these inversion gaps. Excuse me for 1 second. Excuse me. Goodness. That's how I trade the inversion gaps. And this strategy obviously is an ICT strategy. The way I'm trading it is very similar to how Dodgy is trading it. So I want to give credit to Dodgy there for, for kind of, I watched his videos. I watched ICT's 2022 mentorship, so I knew what an inversion gap was, but I never really kind of honed in on the strategy until watching a couple of Dodgy's videos there. So we'll give credit to him for that. And then obviously a B setup would just be like if there was no fair value gap here, right? There's no gap here, and this thing just swept liquidity, created a gap, and then went above. Now, one important thing of note, where price is does matter. So you're not going to take these inversions just anywhere, right? You want to know the draw on liquidity or have an idea of where the draw on liquidity might be. It's going to make it much higher probability for it to work. So that's important. Or you can use the simple rule of, you can use your Fibonacci tool, and you can just fib the leg, right? So let's just use this entire range that we have here. Excuse me, it's the wrong way. Let's use the entire range. And so what I like to do is, if I was looking, if I had a long setup in premium, which means above the 618 level on the fib, then I probably wouldn't take this because we're so high up in this leg, right? And I did not take this. If you watch my stream on Friday, I did not take this entry because I didn't like it. We were so high up. I was favoring shorts. So all I do is I just use my Fibonacci tool and I fib the range. And once we're above the 618 or even equilibrium, I'm no longer looking for longs at that point. Now, would I have taken this long? Yes, because we are still in discount. We are below the 50% level. Not of that range, but this range, because this was the range at that point. So price pulled back, it tapped into equilibrium. So I would have taken this setup here because we pulled back to equilibrium on that leg up. So you want to be buying in discount and selling in premium. Pretty simple idea there. Well, what do you mean buy in discount, selling in premium? Well, it's pretty simple. Does it make more sense to be long here or to be long here? I mean, it's the easiest way to look at it. Down here makes more sense, right? And same thing with selling. Does it make more sense to sell here, short here, or short here? So it's the same idea. You want to be low in the price leg, buying. You want to be high in the price leg, selling. So that's pretty much it. We'll go back to this little chart one more time that we made. So just kind of embed this in your head. If you want to have the highest probability, the highest win rate, you can only trade the A setups. You may only get one of these a day. You may not get it at all. A setup for a long in discount or for a short in premium is going to be the highest probability. You can look for A's and B's and just ignore C's. It's completely up to you. You need to do your own back testing, find out the exact numbers, win percentages for yourself, and go from there. The reason I like this strategy, the reason that it resonates so well for me is because I'm someone who loves to move my stop very quickly. And in this strategy, there's a clear cut spot where you move your stop to break even. There's no guessing. Like before I would be like, oh, I want to move my stop now, even though it's not a reasonable time to move my stop. Now with this, there's no guessing when to move the stop. The strategy simply dictates it for you. So if you have any questions or comments, leave them down below. Again, guys, if you are looking to trade futures, we do have the best discounts above me there. So check those out. Hit that like button, subscribe. I do have a Discord that's $10 a month. Links in the description. And that's it. We'll see you next time. Appreciate you guys watching.